Okay, so I know it's customary to start this off by thanking the conference organizers. But in my case, it's a little weird. I haven't decided if I should thank Jim and Avner or blame them for ruining my ski vacation. So unfortunately, James Dow was unable to make it, and I got about 48 hours to prep for this. And if I'm truly honest, I had other work to do and skiing to do. So Sam and David, I apologize if none of my comments make any sense. On a more serious note, I also just wanted to mention real quickly, I did talk with James Dow via email this afternoon. So he had a couple comments he gave me about the paper. And then the other thing he said, which I think was great news, is that he does expect to have a full recovery, and the doctors did tell him he should be back here skiing in time for next year. So that's the very good news. So here's the plan. As expected, Sam did a nice job presenting the paper, so I'm not really going to summarize it. I'll spend kind of 1 minute giving you guys just my overview of kind of what I thought the big results are. And then I'm going to talk about comments. And weirdly, I'm an empiricist. Most of my comments are going to be kind of thinking about the theoretical forces that might kind of influence what investors are doing. Weirdly, I talked to James. He had kind of no comments about the economics. As a theorist, he was very worried about the econometrics in Table 5. So that's his comment. I actually think he's right, and it just is not going to change anything, but he is right. It's not what I expected him to focus on, but that's what I got out of him. So big picture, let me just kind of provide my summary of the paper. What are the facts? I think they show very clearly that dividends are not clearly visible to all investors, right? And a lot of this is kind of an artifact of history, and it's a little weird. So you look at stock indices, most of the really famous stock indices don't actually account for dividends. You look at individual brokerage statements. So I actually went back and looked at some of my own, and it's true, right? The dividend yields are not immediately visible in a lot of these brokerage statements. And then at least more troubling for me, if you look at a lot of financial websites, and they did a lot of work kind of digging through all of this, you see a lot of them either make it very hard to figure out where the total return would be, and Sam didn't fully mention this, the one that actually is going to give me nightmares is it looks like Yahoo Finance actually calculates returns in a way that arguably is wrong. I mean, it's weird. And they do it differently for different stocks, right? And so then you start wondering about kind of what information all these investors are really getting. And so then what do? Well, the authors basically show that investor behavior around ex-dividend dates is puzzling in kind of a number of dimensions. So one, there's a big dividend distribution in, say, the S&P 500 index. And what do you see? Well, financial journalists tend to be more pessimistic as a result, right? Consistent with the idea that maybe they didn't fully understand what the ex-date result was. On top of that, if you look at the behavior of mutual fund investors, they kind of flow in or flow out of funds in a way that suggests they're not actually fully valuing the dividend yield. And then they have a bunch of other results, but the other one I found very interesting was if you take a CAPM type regression, it was kind of hard to see because of the way the equations were done, but if you just take a market model and you split the market return into a dividend yield piece and a capital gain yield piece and test whether those betas are responding similarly, you find investors seem to be responding much less to the dividend yield piece, right? Which is interesting. And so then from all this, the authors argue that kind of investors' perception is biased by the way in which dividend information is being presented to them. So overall, I mean, everyone always says it's a great paper, but it really is a very interesting paper, and I think it has some very important implications. So I highly recommend it. On top of that, I want to also say kind of two weird side notes. So one, I've always found it a little weird that there's very little research, at least in finance, on kind of history. So we have economic historians. If you look at section 4 of their paper, Sam covered it a tiny bit, but they really do this fascinating deep dive on how practitioners have historically viewed all of this. A lot of it's very puzzling. And they do a really deep dive on the academic literature. And what you see is that it's relatively recent, in fact, that academics have kind of converged on this idea of total return. So one, just if for no other reason, read section 4. It's fascinating. It was really interesting. The other thing is, if you guys have ever read papers by these two, I always find them very fun to read. And my personal favorite part of this is they always add a little color to their text. They talk a little bit about the fact that the Dow Jones is a price-weighted index. And then if you follow footnote 3, it says, from the perspective of modern finance, this is utterly insane. So I want to work stuff like that into my papers from now on. That's kind of my new resolution. So big picture, I believe the results, they hit it kind of from a bunch of different angles. Kind of my big comment is not that I don't believe that investors are responding incorrectly to some of this information, but I also think there's more complicated things that are going on, and I'd like to just see the paper discuss some of these other issues, right? And so that's kind of what I'll talk about. So the first thing I just want to point out is, of course, whenever we talk about anomalies in the data in capital markets, there's kind of different things we think about. And so one story, of course, is that investors are irrational. And so, we're sympathetic to that, but that at the same time, we know that if we have arbitrageurs who have sufficient risk-bearing capacity, they should be able to trade such that capital markets don't actually show these anomalies, right? And so then whenever we think about this idea of irrational investors, we also then start thinking about what frictions might be there that might actually be relevant. And that's something I think the paper should discuss a little bit more in kind of a weird way. So the way I want to think about this, and I don't mean this to offend anyone, but dividends are really boring to talk about and study. And on top of that, if you look at this, they're surprisingly complicated, right? I mean, at a high level, they seem simple, but really understanding everything, I think, requires a lot of subtlety. And so what I want to point out is a couple of things. One, think about just your average investor trying to understand this. Think about a dividend date. There's not a dividend date, right? There's multiple dividend dates. So first of all, we all know there's the announcement date. This is the date on which the firm says what the magnitude of the dividend is going to be. Of course, there's a possibility that that reveals all sorts of information about future investment opportunities for the firm. These guys cleverly, I think, make sure that that doesn't confound their inference. So they're going to focus on the X date instead. But we have these other dates. So there's also the record date. The record date is the date on which they say who owns this thing. And if you're a shareholder of record, then you're entitled to the dividend. Turns out it's way more complicated than that. Many of you probably think you've bought a stock. I would wager the vast majority of the people in this room have never actually been the shareholder of record, right? So you've bought a security entitlement, not actually a stock. There's a shareholder of record that's different from you. And there's all sorts of layers of complexity on top of this. The way that the contracts actually work, they settle with a leg. So if I actually want to be entitled to a dividend on the record date, I have to buy the stock a couple days in advance of that. Right now it's 2 days. For most of their sample, it was 3 days. So there's all these layers of complexity that are going on here. On top of that, there's different tax treatments, right? They've changed through time and they've changed across investors. And there's different implications for kind of thinking about firms and thinking about the impact for investors. So why did I tell you all this boring stuff? Well, there's a quote from Matt Levine that I think sums this up really well. And he says, in life, things that are boring and complicated tend to get messed up because, honestly, who wants to think about that stuff, right? And so I think there are all of these other frictions that may at least be somewhat relevant for understanding the behavior of investors when we talk about dividends. I don't think they explain away the fact that visibility matters, but I would like the paper to see a little bit more discussion of kind of what some of these other complexities are, because I think it is more complex than it may initially seem. So the other things I wanted to mention, the authors have, I think, convincing evidence that investors are making mistakes because dividends are not really visible. But I'm also curious to know who is making this mistake. And one of the points I want to make, and I know Sam knows this already because we talked, I've done a little bit of research looking at the securities lending market, and it turns out if you look at the sec lending data, you can see very clear evidence of very sophisticated tax arb strategies that institutional investors do. So investors with different tax sensitivities will actually use the sec lending market to basically generate a surplus where they avoid certain amounts of tax. They use the lending fee when they trade between each other to split that surplus, and it gets relatively sophisticated. And so when I think about the fact that some investors are screwing this up, I can't help but thinking that, so this is from old work I did with Jake Thornock. So if you look, you can see clearly in the sec lending data that investors are using this market to actually do this div arb, right? So there are very sophisticated investors who are thinking about how to actually squeeze every last cent out of the dividend. So are these guys the ones screwing it up? I somehow highly doubt it, right? I mean, they're doing very sophisticated strategies. So then kind of the natural question is, who is doing this, right? My suspicion is a lot of it is the retail guys. And so I think the paper could do a little bit more to try to understand who is actually making these mistakes. And so the one thing I wanted to point out is there's a recent paper by Bomer, Jones, and Zhang. And what they do kind of cleverly is they noticed that a subset of trades in the TAC database can be almost perfectly identified as being retail traders. So there's 19 different trading venues in TAC, the last time I checked. One of them in particular, there's a trade reporting facility that has code D associated with it. And if you see trades executed on that TRF with an execution price that's at a fraction of a penny, you know with absolute certainty those are retail trades, right? So it's not all retail trades, so this is a subset of them, but you know these guys are retail trades. So I think you guys can do more with this. And so what I actually did was I quickly computed that and just did an event time graph around the X date. So this is selling volume by the retail traders. And what do you actually see? Well, there's an X date, the stock price drops. These guys double their normal selling volume, right? So the retail traders do seem to be responding to this X date pretty dramatically, right? Which I think is consistent with the author's story. And I'm happy to share the code on this if you guys are curious. So overall, I mean, I think the results are convincing. They make sense. I still feel like there are other things that should be explored. And so I don't know how seriously I want to take this critique. But again, dividends are surprisingly complicated. And one of the things the authors do nicely is they use the X date, so they shut down a lot of this information channel. We don't have to worry about information revealed. But I still think that somehow to me it seems like X dates could still be a bad day for investors. And here's how I was kind of trying to think about this. So we all know under certain assumptions dividends are tax inefficient. In fact, from 1926 to 2003 they had this tax disadvantage. So that's the majority of the sample. But kind of one way I think about this is if I'm an investor and the company doesn't pay dividends, I get to choose when it's optimal for me to trigger a taxable event, right? On the other hand, if the company pays the dividends, they're forcing that date upon me. And so to me, it seems like it has to be weakly better for the company not to pay dividends, right? I get to kind of do it in a way that's more tax advantaged for me. So then think about that story. Can that matter? So I'm not totally sure, but I think in some sense it could have some sort of effect on a lot of these stories we talked about, right? So think about something like the journalist reporting pessimistic views on the date on which the X date occurs for the index. I mean, in some sense, that index date is the date on which a portion of the company's assets left my pocket and went to the IRS, right? And I can never get that back. And so should I be pessimistic on that day? I mean, maybe, right? Similarly, you know, they show that investors seem to respond more to price change indices than actually the total return index when accounting for their flows. But you might think that if investors really don't value dividends all that much because of the tax treatment, that's not totally insane, right? And then the same thing I think it holds when you think about the beta, right? So if I decompose the beta into that capital gains piece and that dividend yield piece, well, if there's a large time varying tax that's hitting that dividend yield piece, it may be that we'd expect the beta to be lower on that guy, right? So I don't think you'd expect it to be as low as they show it is, right? So I certainly don't think this could explain everything. But I think there's some of these other things that would be interesting to talk about. All right, so I think I have just a few minutes. So the last thing, this is James' econometric thought. So in table 5, there's a null hypothesis for 25 subsets of the data, and they test whether the dividend beta should be equal to the capital gains beta. And James noticed that you guys do a t-test on the average of the betas, and I think he correctly says you should do an f-test on whether they're different, right? So he was pretty serious about that one. I don't think it's going to change anything. But it was interesting that he picked up on that. So that's kind of James's big comment. So overall, I'm about out of time. So I think the paper is really interesting. I mean, I highly recommend it. It's not only clever, but it's one of those ones that's just fun to read. So if you guys are just find yourself on the plane on the way home from here thinking what should you do, I think this is much better than watching whatever show they have on the plane. They show basically, I think, a couple of things. It's very clear that a lot of different measures are not providing full information to investors, right? I think that's a fact. They show that uncontroversially. And then they show that traders behave differently. And I think my critique is I might just like to see a little bit more nuance in the paper. You can say fact, dividends are not, kind of clearly available to investors. Fact, investors behave a little bit weirdly following X dates. Why is this? Part of it could be they don't fully understand. Part of it could be there's other frictions. Probably all of it's true, right? That's kind of my big critique. But overall, it's a really fun paper. So I highly recommend.